And the markets fluctuated wildly today, with investors reacting to every word spoken and written from Fed Chair Janet Yellen on the first day of her semi-annual monetary policy report to Congress. Yellen said the central bank intends to keep providing support to the U.S. economy, but it was the written report that accompanied her testimony that the market seemed to be fixated on. Steve Leisman has more.
The market getting a bit of a surprise, not from Fed Chair Janet Yellen's written testimony, but from the accompanying monetary policy report to Congress. That report raised questions about whether there were bubbles in some specific parts of the stock market. The report read, quote, valuation metrics in some sectors do appear substantially stretched, particularly those for smaller firms in the social media and biotechnology industries, despite a notable downturn in equity prices for such firms early in the year. Those stocks took a hit before recovering somewhat during the day. Later in the Q&A, Yellen discussed how low rates can distort markets, pushing investors into risky positions and driving up asset prices.
Low interest rates, I think, have had a positive effect on helping the recovery. But, of course, we have to be careful about looking for situations where low rates may be incenting behavior that can be dangerous to financial stability.
On economic and monetary policy, Yellen seemed to keep the markets on track with its belief that the Fed would raise rates sometime in the middle of next year, though she never mentioned a date. She did suggest the Fed could move faster if the economy and job market improved more quickly, or more slowly if the economy lagged. But overall, her concerns were with getting it wrong by moving too early. She noted, for example, that there had many, quote, false dawns when the Fed thought the economy would take off, but didn't. Credit Suisse, in its commentary on Yellen's remarks, said, quote, it seems to us that the Yellen Fed desperately wants to avoid doing anything that could bring a premature end to a recovery that finally appears to be gaining traction. While Yellen suggested there have been better results in the job market, she said wages have a ways to run before they will cause concern at the Fed about inflation.
While rising compensation or wage growth is one sign that the labor market is healing, we're not even at the point where wages are rising at a pace that they could give rise to inflation.
What's clear is that Yellen and the Fed have a keen eye on market valuations and the economic data, especially the jobs data. There's a market expectation the Fed will keep rates in check until next summer and gradually hike them next year. But Yellen made clear it's not a promise, and the plan is only as good as the data. For Nightly Business Report, I'm Steve Leisman.
Now, before Janet Yellen's testimony, the major stock averages started out higher. The Dow even reached a fresh intraday high following more solid bank earnings, good news about New York State manufacturing, and slight increases in June retail sales and import prices. But by the close, stocks pulled back, ending the session mixed. The Dow added just 5 points and is only about 7 points away from a new historic high. The Nasdaq, where a lot of biotech and social media stocks trade, lost 24 points, and the S&P was off by 3 points.
And joining us now to talk about the markets, Chair Yellen and more, Russ Kestrich. He's a Global Chief Investment Strategist at BlackRock. Russ, welcome back. Good as always to have you with us. What worries you in the market today?
Well, ironically, it's a lot of what I think the Fed chair spoke about. You know, generally, I don't think financial markets are in a bubble. I think valuations are probably a little bit above average, but they're reasonable given the low rate, low inflation environment. But as we read today, the challenge is there are parts of the market, and Janet Yellen mentioned a couple, that do look very stretched. And the longer we have a monetary environment in which conditions are this unusual, the greater the danger that more areas will become stretched because people are searching for yield and growth in a low yield world.
You know, Russ, it's very rare to hear a top Federal Reserve official talk about specific parts about the stock market. I mean, what's the danger of being that specific about stock sectors and subsectors?
Well, you know, it's a fascinating question, and I don't think Janet Yellen is trying to get a job as an equity strategist. I think the point of this was really to say, we get it. The Fed has been under a lot of criticism about this very topic, which is that there is a cost to keeping rates this low for this long, and the cost is you raise the risk of inflating asset bubbles. And I think what the Fed chair was trying to say today is, look, we're aware of this. We're cognizant of the fact that there's certain parts of the market that are extremely stretched. Now, what's important is also what she didn't say. And I think implicit in the fact that she really highlighted just a couple of sectors is the notion that the Fed does not believe that the broader market, whether we're talking about equity or credit, is in a bubble.
That's a fascinating point. So what I intuit that you're saying is that in those parts of the market that are stretched, where you find the Pandoras and the Groupons and some of the biotechs, that can snap back and hurt you. But that there are pockets of value. Where are they?
There are pockets of value. I think they're in a couple of places. In the U.S., generally larger is cheaper. We've had a huge run in small caps. Those valuations are roughly twice what they are for large cap companies, at least on a price to earnings basis. Large looks cheaper. More cyclical companies look cheaper. The reason is, again, people have been stretching for yield in sectors like utilities. The more cyclical parts of the market look less expensive. And then finally, what I'd emphasize is that the U.S. has been outperforming for a long time. That's arguably justified because U.S. growth is stronger, but it's left U.S. stocks relatively expensive compared to the rest of the world. And for the most part, stocks in Asia, other parts of the international sector do look less expensive than stocks in the United States.
All right. So for the average investor who's listening to all these comments that you're making and seeing the headlines about Janet Yellen, what's the takeaway here for them? Should they be feeling good now to put their money in the market or what? I mean, connect the dots for us.
I think there are a couple of dots to connect here. The first of which, again, going back to the comments by Janet Yellen, be careful. Be careful of some of the momentum parts of the market where valuations have just got to unsustainable levels. Those are dangerous. The broader market still looks reasonable. You can still make money, but, and this is the important caveat, stocks have really gained quite a bit through multiple expansion. They're not nearly as cheap as they were 2 years ago. And even if stocks go higher over the next year, which we expect, the rate of gains is likely to be slower over the next 3 to 4 years than they've been over the past 3 to 4 years.
Russ, thank you so much, as always. Very helpful. Appreciate it.
All right, thanks, Tyler.
Russ Kostrich of BlackRock.